Let's now move to the third and last form of market efficiency. Olivier, could you please remind us of this last definition?
Okay, so let me remind you the definition on strong market efficiency. So if you remember, what we will add is private information. Now, of course, a natural question is whether is it possible to test for the strong form of efficiency. If you look at the definition, well, by definition, it will be very difficult because it's a private information and as a statistician or an econometrician, in fact, I don't have access to your private information. So it's very difficult to come up with a really good test about whether you can indeed exploit private information or not, and whether it's reflected in the prices. Now, if you look at the 90s, and in fact, at that time I was really a fan of a very well-known film where you had Michael Douglas, and that film was called Wall Street, and it was related to a vague of a lot of trials and legal issues related to what is called insider trading. And so what is insider trading is, in fact, to exploit your private information to take a bet on the future returns and the future price on the company. And obviously, if you look at those trials, in fact, those guys made a lot of money based on that inside information. So I think that Tony will have something to say about perhaps ways to avoid to exploit that type of inside information.
Well, I was mentioning before that market forces, competition among traders, will make a market naturally more efficient. But when you think about strong form efficiency, the same reasoning doesn't apply. The holder of the private information is usually one individual or a small group of individuals, and there is not really competition among them. So we need an outside player to regulate a market to make it more efficient in the strong form. Typically, these outside players are public authorities. You can think of the Security and Exchange Commission and other regulatory agencies.
Okay, so thank you very much, Tony, for explaining why, in fact, we need some regulation if you want to avoid insider trading. So now can you wrap up a little bit what we have learned today?
Absolutely. So the main message of market efficiency is that it casts serious doubt on the profitability of very simple trading strategies. This is related to the weak form, a semi-strong form market efficiencies, looking at past prices to infer predictability and structure. Looking at publicly available information is of course useful to assess the risk and expected return of an investment, but it's not likely to create a free lunch and a very profitable investment strategy only based on that information. What we can probably expect is that market forces are going to render market efficient in the weak and semi-strong form, and the strong form efficiency is probably enforced by the presence of regulatory agencies. If markets are efficient, we can expect prices to be very hard to predict. What we can probably assess is the expected return associated to the level of risk of a particular strategy. But obviously, it's going to be very hard to construct profitable strategy simply based on observing price patterns and publicly available information that is easily accessible and almost at no cost.